Hey, welcome to Front Range Facts. This is Anthony Meisner.
And this is Jim Marion.
We're here to give you your national update.
Yeah, I want to take a look at a little bit about the outlook, what we feel that's headed into 2024 now that the new year's begun. So, Anthony, we're getting mixed economic signals a little bit, aren't we?
Yeah, I think this has been happening for the last few years, ever since we came out of all that economic stimulus. You print trillions of dollars, and then no one's ever done this before. So naturally, we're all trying to figure it out together as we go. But the big thing here is things are starting to look better than they have been. Right?
Yes.
I think that's everything's sort of trending in the right direction outside of our national debt growth, just the capacity and utilization has dropped. So there's a couple of negative factors here, but as a whole, these are good signals, right?
Yeah,
we're seeing some good stuff going on.
And I think it's important just to note that we're going to be showing you some slides right now from University of Colorado Lead School of Business. They were nice enough to do, as they always do every December, an economic outlook for 2024. It's one of those events that's highly recommended you go to. This past year, Anthony and I attended it, a month ago, basically in December, and great information overall. And this, is from kind of their outlook of things. And so there are some, pushes and pulls, some headwinds, if you will. I'd say certainly commercial real estate was the thing they were most down on, which, kind of we avoid as much as we can.
Yes, us being the residential guys, we probably don't look much at that.
But. Yeah, but it is going to be a headwind just for the market as a whole. So I think let's start with inflation, right? That's the big number here
that's the one that everyone's been looking at, right? So, elephant in the room. What are they doing? Like, what are we looking at?
Yeah, and I think it's improving overall. When you're trying to slow a frigate, as large as the U.S. economy that's measured in trillions of dollars. It takes time for effects to change, right? So you can't just change this overnight. And I think the Fed's been very, very wise to stop the interest rate increases to just see what the effect has been on the economy. And it's clearly showing that boat is continuing to slow down. It's not rising as fast. And in fact, a lot of the difference now between their goal of 2% and what we're seeing here is like the 3%, the 3.4, 4.5 is what they're now calling greedflation, which is essentially companies that just increase price because they felt they can get away with it. And so most of this overage now isn't essentially economic policy as much as it's company policy for a pricing perspective.
Yeah, absolutely. And all of the leading indicator data that's showing where this is headed it's all headed towards that 2% target that they're looking for. The real question is how long does it take to get there? So I think the one thing that why the Fed has just kind of hit the pause button, which they did today again. So the big deal there is they just want to wait and see because everything's looking like we're headed right towards their target, right? Soft landing is literally what's about to happen, I think.
Exactly. Yeah.
So this is all good signs. I mean, obviously housing, you see that 4.8% is one of the higher numbers there. Goods and services, I think everybody feels that the most, that 5.5% increase. But look at some of these. We're seeing some negative numbers now in this. So especially in our mountain region.
There's worrisome things with tenants not being able to afford rent. There's quite a few that are having troubles with that. So that's so to be cognizant of. And then also the MSA that we're in, Denver, Aurora, Lakewood, right there, we're always above the national average when it comes to inflation. But that's because we always compensate with higher wages and our home appreciation is better. But let's take a look at household debt because I think this is important. What we're going to do now in the next few slides is talk about just why the economy is overall healthy, essentially, and why we feel that interest rates are going to continue to drop and why prices are going to continue to rise. So that's the thesis we're kind of going over here today. And I think it's important to look at household debt growth to show how much it's moderated, essentially. As a percent of disposable income, both of these are falling very nicely in line with affordability, even though housing as a whole has been more expensive, the last few years. Look at where these numbers are. We're better than anything for the last 20 years, essentially, except for that, period of, pre-COVID, 2015, 2019, we're kind of on par with that, which was a pretty healthy place to be overall. It saw some moderate price increases with homes. It saw everyone doing fairly well, in a robust market. So good signs. It's restoring back to more of a sane level. And also now looking at retail sales, that red line is kind of just the general trend line. But the tan line behind it is what the actual, retail sales have been in millions of dollars. And when you look at the fact that we're above that trend line significantly, and look how much we've jumped just in the last few years, we're very strong retail sales. And when you look back at, that household debt growth shrinking as well, it's showing in the retail sales increasing essentially, with people being able to afford more.
Yeah, the interesting number there that I don't think the Fed expected was the 5.6% year over year increase in retail sales over the holidays.
Yeah.
It was higher than expected, and it shouldn't really have been that high, but people are still spending money. So
it's interesting in that regard because the savings, personal savings, is not at the COVID levels, but it's kind of back to where it was, right?
Right.
And so that personal income also is kind of back to where it was pre-COVID as well. And so I think you're right. It seemed to be a little bit more robust with the sales data than it should have been from what we're seeing overall. But part of it may be this, right, Anthony?
Yeah, I think the biggest thing is, remember, city centers are built on office jobs, right?
Yeah.
They're built off of, maybe some retail, but there's not a lot of manufacturing going on in the cities. And where was all the growth after the pandemic? And where do we see all of the, that investment went to those office workers, even though they might be more work from home, even some today still. But you've seen this boom in white collar job office growth, right? That office industry growth, and it's way above the total for the United States. That really has changed, the outline of who's working and where they're working over the course of the last couple of years. And look at that 100% line. This is like pre-pandemic. Yeah. Where were we to where we are today? Yeah. Even retail is above where it was then. So this is a good sign.
I think the other thing to point out here, when talking about kind of the robustness of the economy, this resiliency, and we still get these Chicken Little reports of recessions coming, right, or anything. Well, to have a recession, you need to have these numbers be closer to that 100 line, right? I mean,
absolutely.
Because right now what we have is cushion for the pushing. I mean, that's what this is, right? There's certainly a lot of cushion right here in case something were to go wrong. Because most recessions, we're talking about a 3% drop, right? It's not huge right unless it's COVID, where it's like a 14.5% drop. It's usually about 3% or so drop. And so we have 105% of jobs and stuff. There is serious good cushion for that. And that's the other thing right here too. Take a look at how many people have jobs and how many openings there are for those non-existent people that need to get hired, right?
Yeah. Anytime we put a job opening at Atlanta Title right now, it's crazy how many applicants we've gotten, and it was not like that even a few months ago. So
we could cut the available jobs in half and still have more jobs open than there are people to fill them. So there is quite a bit of room in this economy to A, go higher, and B, if we do encounter some bumps in the road by something strange, to cushion that blow still and keep us intact.
So interest rates, this is the elephant in the room in 2024 is what's going to happen, but you can see the world's largest increase as fast as physically possible from 22 to 3, literally the fastest we've seen since the 80s, right? Yeah. So we see this huge jump. We kind of peak out and stutter out around 8%. And then all of a sudden, we start getting some good factors, some good indicators that things are going to start heading down. And they really have responded quite well.
And
quickly, right? So fast up, we're going to see a plateau, fast down. And now everybody is kind of watching to see where they land. Now, I think the target's like 6%. If you see around 6%, that's what we saw back in the 2000s. Things tend to continue to move, right? People are kind of hamstrung at that 7-8% range. It's so out of reach, but with all the other debt and all the other stuff going on, if we could get to about 5.5%, I think you'd see people break their 3% loans and then make some more decisions for themselves. So buyers may enter the market earlier because we're talking 6.5%, 6% for buyers to really engage in the market and come back out in force. And then that's 6 to 5.5% for sellers, which could be all the way to 2025. So good sign is, we saw the worst of it. Bad sign is we're not quite there yet to engage everybody.
But that reddish brownish line right there is the 30-year mortgage, the one we care about the most. 10-year Treasury is that black line. And why do we feel that the rates are going to continue to drop? It's because the spread is too high right now.
Spread's too high.
People want to invest in a 10-year versus a 30-year. If there's a certain interest rate spread that averages 1.72 over history, as long as it's in the line of that, then it's good. When it gets out of line, like it is right now at 2.78, that means there's too much of a gap there. There's opportunity for investment, essentially.
Well, sure, the banks are literally just padding their numbers because they know that it's going to change.
Yeah. So clearly, just if you look at history as a judge, the rate will go down, if nothing else, because the spread's too high.
Absolutely. That's a whole point right there. We basically have to rely on.
Exactly. And so, where are we predictably now? Well, the rates, have been heading down. This slide is, a few weeks old, but basically we're at like 6.89, I think, today or something like that. So we're bouncing around. We're below the sevens, which is where we need to be. And when you look at just where the numbers are headed, we'll talk about that in a little bit as well. But right now, the other thing I want to talk about is home appreciation and where we're at with things. We are very much in line with the law of averages here.
Yeah, it was like 4.8% for all of last year, and the 42-year average is 4.9%. So, outside of the recession caused by real estate, like,
and for anybody who thinks, hey, I'm waiting till home prices drop, I always look at them like they're the craziest person in the world, essentially, because history has shown that essentially since 1948 maybe, prices have always gone up by some measure, essentially, except for this pit we dug ourselves as an industry in the 2008 crash. So prices even in a bad year go up. It may not be a lot, but they're going up.
Or even like here where they just stayed flat for the year. Flat is not so bad for what we were experiencing, right? We saw 40% of price appreciation over the previous couple of years. So that being said, all right, what about this? Mortgage rates?
Yeah, I want to talk about
5%,
why,
huh?
This is another reason why prices have stabilized. They're staying strong. We went up this past year, even though the interest rates were awful.
Totally.
It's because people, again, we've talked about the golden handcuffs before. This is a breakout of where people sit. Now, Anthony, the one thing this doesn't even reflect is about 50% of all homeowners I think it's like 48, have fully owned their homes, so.
Oh yeah, this doesn't even talk about the cash portion of homeowners, which it's remarkable, the real estate wealth. It's, like 30-40 trillion dollars in real estate wealth in this country. So this is why it's so critical, that we're just kind of stuck here until interest rates start to come back down, because 78.7% have a rate less than 5%. I mean, it's going to take a lot to break that group loose that are under 3%.
The blue and green are the only ones that really, unless you've got a divorce or some serious financial issue, or you just want to go move out of Dodge and get to the land of rainbows, fine. But otherwise, you're going to stay put, and that's reflected here in this survey of people who have current mortgages right now. If you're a realtor, your target market is the green and blue. I mean, if you're looking for,
it's a really different crowd than we were working with before, isn't it?
So, they're not selling. They're probably not selling. They must. I love this one. Must think before selling. Implying
this is like 6 months to a year waiting for rates to come down, kind of thing.
Well, implying that the people who are probably yes or yes, they don't think, they just do. I love the insinuation there. So.
I love it.
There isn't. The point is there's not a lot of inventory that's going to be coming out. We don't have a 2009, 2010 wave of inventory like we saw then, right? There's nothing on the horizon that's. We just showed you guys slides that show the economy is robust, the deployment's robust. We've got cushion in case something goes wrong, and now we've got the golden handcuffs fully in effect, showing that people are not going to leave their home. So what does that mean with prices? I mean, that's really where it's headed, right? And this is another thing. The top reasons buyers are pausing their decisions. Number one, huge mortgage rates.
Obviously,
what's happening with mortgage rates? They're going down, right?
They're going down, so that's going to help in that category. The inventory, though, this is one that I'm really going to harp on, especially when we get to Colorado and local updates later. But inventory nationally has still been challenging. We just don't build enough homes. And this has been our thesis since we started the podcast.
We never seem to be able to do that, no matter what we do. So, oddly enough, affordability isn't the big thing. It's your monthly spend. This essentially is what it comes down to, right? How much is it costing me on a month-to-month basis to pay for this? Okay, I can stomach it. I can't stomach it. That's choice.
It, right?
And so, new and existing home sales. Wanted to take a quick look at this just to show you how rotten.
This is wild.
Guys, if you want to buy a home, this is like if this was a stock, you'd be like, oh my God, these are buy signs all over the place.
All
this
over
kind
the place.
of stuff. This is when you buy on the dips, you get out when it's up at the peaks. That's 101 economics, right? And so here we are, guys. This is buy signs all over the place. Everything is about its lowest level that you've seen, since '99. And heck, I think our inventory is at the lowest level ever historically. So
it's not great. And the interesting part about this new and existing home sales is look at the new sales. Like they really did remarkably well, but because they bought a lot of money to be able to help facilitate some of that.
That's right.
But,
that's the construction that bought mountains of money for super cheap and lined it up before the crash. They did very well in hedging their margins, right? And then they utilized that. They weaponized it essentially to be standing out from the resale by saying, hey, we'll do 2 or 3 points less than what you could get by buying a resale, buy new.
I think the important part about this, though, is they're going to come back together. right? They always do. And the big thing here is they're both going to trend in the same direction at some point. So those new home sales are going to start to slow down probably, but then they're going to catch resale about the same time that resale really starts to pick back up.
Yeah.
So that ought to be interesting.
So we put on our crystal ball here, and we wanted to show you a little bit about where we think things are headed. So I think first off, just before we talk about home price appreciation, when it comes to rates of mortgages, here we are at the beginning of 2024. My opinion for the end of 2024 is we're going to be right around 6% interest rate. There are people who are like, oh, we're going to be in the fives. I don't see the trend because the Fed is not going to lower rates until May or June, is what they're kind of forecasting at this point in time themselves. And so until that happens, we're going to be kind of just putzing around the same rate, roughly, small little dips here and there. But what do you think, Anthony? I mean, you think for the rates we're going to be below 6?
No, I really don't. Unfortunately, I honestly don't think unless you buy some points, you're not going to see hardly anything below 6 this year. But that's not necessarily a bad thing. I mean, if we put too much money back into the economy too quickly, we'll be right back in the same problem we had. We don't want that. So we need this to slowly stack back up, because if sellers aren't going to come to market fast enough, the buyers can't respond in a wave. Right, we don't want to be back where we were in 21 or 22.
$100,000 every year.
Yeah, and I think all of this stuff in this forecast really suggests the same thing. It suggests this like slow, steady increase in mortgage rates, and I truly don't think you'll see a ton of relief until the middle of the year. Right, the one thing the market will do is the second the Fed drops rates one time, the market's going to rally behind this, and interest rates are going to drop quickly because a lot of those bank margins will start coming out.
Yeah, that spread difference between Treasury and 30 will be tight.
Yeah, and I don't think that's going to change until you start to see that. So even if we talk, June or July before you start to see some relief in the rate, I mean, half a point change in a year is actually quite a bit. Yeah, and it's going to take place in 6 months, not in.
And we've been talking about this since last fall, that fall 2024 is really where the market's going to start to shake up and come more awake, we think.
Yeah, I think Q4 this year is going to be remarkably exciting because you're going to see lower rates, you're going to see buyers coming out, you're going to see sellers getting engaged, and it's going to be kind of the inverse of what we saw in 22.
The seasonality is going to be totally flipped on its head a little bit, we think. So now let's get to this slide right here. This is just prognostication of various different banks. The average of all 8 is 1.5%. So as you can see here, most people or most organizations think that prices for homes are going to appreciate. Realtor.com has a 1.7 negative for some reason. Now you see that Zillow one, it's got a 0.2 negative. I wrote 3.5 above it, and that's because this was based on November 30th, right? And then rates dropped very significantly. So Zillow was like, oh my God, it's no longer going to be a negative year. It's going to be a plus 3.5% year.
Absolutely. And look at it by county. This is super fun to watch.
Yeah.
I love these like scatter maps because it helps us visualize a little bit what's going on. Obviously, it's really easy to tell where we are in the middle of the country, but it's this is fun. There's very few negative spots in the country. It's just unlikely that you're going to see real estate prices suffer because of the inventory shortage.
And you're probably going to see these predictions continue to go higher because they're all based from before Zillow said, oh my God, these other organizations don't usually change as rapidly. So
look at the NBA. I think the NBA has the best foresight this year, and I'm not just saying that because of because it's
they're always highly optimistic,
but they're optimistic for a good reason because we had 3.8% last year, 4.8%, something like that, right? Yeah. So we had all this appreciation in a year where things were really tough. Yeah. If you're going to start putting money back into the economy, housing prices will increase.
Absolutely.
Right? There's just no way that we're going to be negative.
Yeah. All right, folks. So 2024 is going to be slow and steady, slowly positive. Over time, we're going to see interest rates continue to slowly decrease, with probably a big bump when the Fed does their first drop, and we're probably going to see home prices go up, let's say 3-4% again, just like I think it was 3.8 is what we ended up last year. But
optimistic 2024. That's our outlook.
Slow and steady. All right, folks. Well, thanks very much. I'm Jim Marion, realtor here at Coldwell Banker. Give me a call at 303-548-0243 or shoot me an email to jim@ourcoloradohomes.com.
I'm Anthony Meisner with Land Title. You can always reach me on my cell at 303-968-9868 or ameisner@ltgc.com.
And don't forget to tune in to our state and our local forecasts as well for this year. So take care, everybody. Have a good one.
Bye.